In October 2025, Bitcoin reached $126,000 per coin. It was the highest price in the asset's history, driven by institutional capital, ETF inflows, and a Federal Reserve cutting interest rates for the first time in years. By May 2026, Bitcoin was trading near $70,000, a drawdown of 44% from that peak. On paper, the story looks simple. Price went up, price came down. But beneath that surface, something unusual was happening. During that entire correction from peak to trough, US-bought Bitcoin ETFs absorbed $47.2 billion in net inflows. Institutions were not selling, they were buying. This documentary explains the mechanism behind that divergence. Understanding why requires understanding three things: how Bitcoin ETFs mechanically work, what actually caused the correction, and how institutional capital behaves differently from retail capital in a drawdown environment. Inflation stayed above 3%, reducing expectations of future rate cuts. That removed key support for risk assets like Bitcoin. Let's look at the charts. The CPI chart shows inflation above 3%, and the Fed dot plot shows fewer cuts projected. ETF saw 6.3 billion outflows during year-end institutional rebalancing. Tax loss harvesting amplified the selling pressure. Here's the chart showing the negative flows in November and December. The total outflow was 6.3 billion, highlighted during the rebalancing window.
The drop wasn't one event, it was three macro shocks in sequence: geopolitics, monetary tightening expectations, and institutional rebalancing. Let's look at the timeline. First, geopolitics, then tightening expectations, finally institutional rebalancing.
Tariff fears triggered a 15% intraday crash and 19 billion liquidations. Leverage made the downside move immediate and violent. Take a look at the charts. This vertical drop shows the 15% crash.
Bitcoin fell to $82,000 by December, a 35% decline. Three macro forces converged into one sustained correction. Let's look at the full drawdown chart. Three arrows converging onto the price line with the 35% marker.
By early 2026, price stabilized near 70K, 80K. But ETF flows told a completely different story underneath. This hidden divergence shows price is not equal to flow. A spot Bitcoin ETF is not exposure, it is direct Bitcoin demand. Every share sold forces real Bitcoin to be bought in markets. Let's look at the mechanism. Issuers like BlackRock must buy Bitcoin for every ETF creation. That Bitcoin is then moved into institutional custody. The process is spot-backed, verified, and secure. Authorized participants maintain price tracking through arbitrage. They bridge ETF shares and real Bitcoin markets continuously. This AP arbitrage loop illustrates the process. The prices converge as the spread tightens. 88% of all ETF capital stayed invested through the drawdown. That level of retention defines a new market structure. Let's look at the stability heat map over time and our rising capital stickiness index. Why institutions bought the drawdown? The real question isn't why some sold, it's why $47 bought. The answer is structural allocation behavior, not sentiment. B-roll. Institutions maintain fixed portfolio weights for Bitcoin exposure. When the price drops, they are forced to rebalance higher. This target allocation system ensures consistent exposure. Let's see how it works.
Institutions maintain fixed portfolio weights for Bitcoin exposure. When price drops, they are forced to rebalance higher. Here's a portfolio allocation pie. The BTC weight shrinks, then restores. This rebalancing trigger activates the target allocation system.
This is systematic rebalancing, not discretionary trading. A 44% drawdown becomes a mechanical buy signal. Let's see the automation-style flowchart. The trigger is a price drop leading to a higher buy requirement. Morgan Stanley expanded ETF access to 15,000 advisors. That opened Bitcoin exposure to managed institutional portfolios. Here's the advisor network map and the wealth management dashboard. Finally, the ETF integration layer. In April 2026, ETF saw 8 straight days of inflows. Even during a drawdown, capital continued to accumulate. Here on the chart, you can see the streak and a clear divergence between price and inflows. BlackRock captured 70% of April inflows alone. Institutional conviction was highly concentrated at the top. Let's visualize this dominance with a pie chart. And here's the competitor comparison and concentration hit pane. On-chain data shows where Bitcoin is actually being held, and it reveals a shrinking supply available for sale. Let's look at the Glassnode dashboard. We see supply distribution layers with exchange reserves shrinking while cold storage grows. Exchange reserves fell to 2.21 million BTC, a multi-year low. This means less Bitcoin on exchanges and less immediate sell pressure. This creates a supply squeeze, which is bullish for Bitcoin. One day alone saw 32,000 BTC leave exchanges. Most of it moved into long-term custody. This chart shows the single-day spike. The arrows show the flow into cold storage, worth 2.26 billion. Long-term holders now control 75% of circulating supply, and they kept accumulating through the entire correction. This chart shows the LT8 supply rising steadily. Strong hands now dominate the market.
Whale wallets added 270,000 BTC in a single month. Large holders aggressively accumulated into weakness. The whale accumulation heat map shows where they bought. 270K BTC spike confirms the massive volume.
Bitcoin's marginal buyer has changed, and so has its structure. ETF demand now dominates cycle behavior. This diagram illustrates the market structure evolution. Retail shifts to institutional with ETFs on top. Earlier cycles were driven by retail leverage and forced liquidations. That created deeper and more violent drawdowns. Let's look at the 2017 and 2021 crash charts. This animation shows a typical liquidation cascade. And here are the leverage wipeout heat map. Now, structural buyers absorb selling pressure instead of amplifying it. ETF flows and rebalancing stabilize the downside. Let me show you a support layer diagram under price. ETF, institutional, and LT8 buyers create a cushioning effect. Now, structural buyers absorb selling pressure instead of amplifying it. ETF flows and rebalancing stabilize the downside. Let's visualize the support layer diagram. ETF institutional and LTH stack support cushion the price. ETF demand has exceeded daily mine supply consistently. New issue ocean is no longer enough to meet demand. Here's the supply versus demand bar chart. Note the supply deficit indicator. ETFs now control over $102 in Bitcoin exposure. That locks a meaningful portion of supply into long-term holdings. Let's look at the AM growth curve to 102B and the lock supply visualization. The 44% drawdown was real, driven by 3 macro shocks, but it did not break institutional demand. ETF inflows, low exchange reserves, and whale accumulation all persisted. The structure underneath Bitcoin strengthened during the decline. Our dashboard shows green dominance indicators across ETFs, reserves, and whales, and the structural strength index is rising. Future price action depends on rates, yields, and ETF flows. Not sentiment, but macro liquidity conditions. Let's look at the macro triangle and the liquidity cycle graph. Finally, a forward-looking scenario grid.